Just a reminder, everyone, of the disclaimer. So anything we talk about today is for educational, entertainment, and information purposes only. Hey everybody, I wanted to do a quick video on IV rank versus IV percentile. I think that's pretty important because we are given both of these typically in certain platforms like Thinkorswim. You can get it on things like Barchart. And it's important to understand the difference because some platforms actually get them mixed up. So I'm going to give you a funny little old joke basically to start with, which is, let's take a bar full of 10 people, and then we're going to introduce somebody very, very well known to the mix. So we take all these people and their annual incomes, and we take the average, and we come to $50,500 per year for the average. Now, the median is going to be the middle, right? And because it's 10, we don't have a clean middle, so we've got to take the two middle numbers and divide them by 2, which gives us the 47,500. So the middle income, in a sense, is 47,500. The average, which is also called the mean, is 50,500. So you may have heard mean before. If you go back to your high school math, basically just average. We call volatility a mean reverting measurement because typically it gets very, very high at times, comes back down towards the mean, the average. It gets very, very low sometimes, and eventually comes back towards the mean reverting. That's something that many funds play. People play that, they'll play mean reversion in relationships, in pair trades, etc. Lots of different ways to play mean reversion. Hey everyone, if you haven't subscribed to the channel, please do, and be sure to download my free Options Cash Flow Blueprint, a step-by-step guide for how to go from complete beginner to options ninja. Now back to the video. Now, what happens? We add Bill Gates to the mix. Bill Gates walks in and he has $1 billion income. Lucky him. Jack leaves, and so we still have 10 people, but including Bill Gates. The average income now is over $100 million. The median income is still $47,500. So the average income isn't very meaningful to us anymore because we have this real outlier number that skews everything up very, very severely. So if you were to sort of walk into that bar and somebody said, well, what do you think the average income is? You would never guess, if you didn't see Bill Gates sitting there in the corner sipping on his beer, you'd never guess it was this high. So the $100 million number isn't very meaningful, is it? If we were to sort of look at this place and say, well, what gives us a good idea of what the average income is? Well, the average isn't very meaningful and it isn't very helpful. And sometimes in statistics, in sort of examples out there, and particularly in trading, that's not very helpful. So let's look at the two main measures of where we can rank volatility. So let's figure out where implied volatility is in the grand scheme of things right now, right? Is it higher than normal? Is it lower than normal? Is it about mid-range? And why do we want to know that? Well, as option sellers or option buyers, we understand that volatility is mean reverting. So if options get very, very cheap, we have a hunch that they could at some point come back towards the mean. So they may get more expensive. Or for option sellers, if they've gotten a little bit too expensive, we have a hunch or an intuition that they may start to come down as volatility is mean reverting. Now, the truth of the matter is, options can stay cheap for a very long time and they can stay high for also a fairly long time. But we definitely want to know where we are within this sort of range in order to make sure that we aren't overpaying, that we really aren't selling something that's a little bit too cheap as well. And perhaps sometimes that we don't want to sell something that's actually too expensive because it might suggest that something else is going on out there. So we're going to get to that at the very end. So as option traders, we are volatility traders, and that's why we're talking about this right now. Volatility matters, historical volatility, implied volatility, and the range of volatility that we're seeing right now. So let's talk about the first measure, which is called IV rank. So where are we within the scale of 0 to 100? This one's pretty simple. So I'll give you an example. If implied volatility at the very low end for the last 52 weeks was 35 and the high was 85, we can see that there's a difference of 50 there, right? So our range is from 35 to 85. So the very middle of that range is going to be 60, right? 35 plus 25 is the very middle, plus another 25 is 85. So if the implied volatility right now is 60, we would call that the 50th percentile IV rank, right? The 50th percentile rank. What would an IV rank of 75 be? For example, where would 75 be within that range of 35 to 85? Well, you can use this calculation, which is the current IV minus the 1-year low over the 1-year IV minus the 1-year IV low, right? So you're going to basically plug it in. You're going to say the current IV is 75 minus the low of 35 divided by 85 minus 35. And that's going to be an IVR, an IV rank of 80. So 75 would be an 80 IV rank. So that would be telling us that implied volatility is starting to get to the upper end of this range that we have seen over the last year. And similarly, if the IV was down around 40, we would figure out that we are basically near the very lows of the year. Now, the second calculation is called IV percentile. And it also measures the data in a range of 0 to 100, but this time the number represents how much of the time the implied volatility has been lower than the current IV. I know these sort of take a little bit to click, but really think about it. The IV rank is just very simple. It's just a range. Where are we from that scale of 0 to 100 in that range of implied volatility that we have seen over the last year? The percentile is different. It is saying that if that IV percentile, for example, I give you an example of 80, an 80 percentile means that 80% of the time the implied volatility has been lower than where it is currently. An implied volatility percentile of 50 means that 50% of the time over the last 52 weeks, the IV has been lower than where it is currently. Now, the important difference, if you start to really think about it, is that IV percentile suffers much less from those outliers. When you have a really big outlier move, it's kind of like our Bill Gates example, that is going to really skew your IV rank. If your implied volatility just suddenly jumps from 50 to 80 one day, then for the next 52 weeks, there's going to be this sort of outlier move that is basically pushing down the current level of ranking, right? So let me give you an example. Let's take the SPY, which is the S&P 500 index ETF. So in Barchart Premier, we're going to bring that up in our price overview on the left side here. And it's going to bring up a lot of information, a couple of tables here. Here's your chart, which you can expand to take a closer look at. But you've got all kinds of interesting information. And down in the options overview section, you can see the current implied volatility, 30-day implied volatility. It's 19.32. And below that is historical volatility. So that's how the SPY has been actually moving up until now. So remember, implied volatility looks forward, historical volatility looks into the past. And right below that, we have the two things that we're interested in knowing. So we've got our IV percentile of 94% and our IV rank of 47.82%. Notice how drastically different those particular figures are. And it's exactly due to what I've been talking about here. So let's notice that the high IV for the year is 29.87 and the low IV for the past 52 weeks is 966. And so just so happens that 1932, which is our current level of option pricing, is just about right smack dab in the middle of these two figures. And that's how IV rank works. It just takes a look at where are we currently within the range over the past 52 weeks. So very, very simple to calculate. We're at the 47.82 IV rank. Now, why is the 94 so high? Well, remember, we were talking about IV percentile. That's telling us that 94% of the time over the last 52 weeks, the IV, the implied volatility, has been lower than the current one, 19.32. So let's go over that again. The percentile means that 94% of the time, so the vast majority of the time over the last 52 weeks, the implied volatility has been lower than where it currently is. So if you were to look at the IV rank, you would say, well, we're kind of like middle of the range volatility. But what IV percentile is telling you is that really we're rarely higher than we are now. So for all intents and purposes, we're at a fairly high level of volatility compared to all the data sets over the last 1 year that tell us that most of the time, by a very large degree, the implied volatility has been lower. So let's take a look at one of the great features in Barchart is that you can chart implied volatility. And for different expiries, different tenors, right? You can look at 30-day, 60-day, 90-day, et cetera, et cetera. So you can get really, really granular and also with moneyness. So, looking at different deltas, et cetera. So but what I've done here is I've taken out historical volatility. I just have implied volatility in this orange or gold, and I have IV rank in the red and IV percentile in the green. So even though implied volatility is quite high from an IV percentile perspective, that almost 95% of the time implied volatility has been lower, our IV rank is only down under 50. Now, why is that? Because the rank is considering the entire range of what has been observed over the last year. What has been the absolute low in implied volatility and what has been the absolute high? And we noticed that last August, when we had that very, very quick, sharp sell-off, implied volatility absolutely exploded higher. And so from IV rank's perspective, this still exists in the history, right? So even though implied volatility is sitting here in the orange and it's quite high compared to almost any period, it's this one single spike that drove us to extremely high levels of implied volatility, which is kind of the Bill Gates outlier. This is the Bill Gates that's walked into the volatility room here and has pushed that IV extremely high. And at least until this period drops out of the 52-week data set, this is going to represent the high. So even though volatility tends to almost always trade quite a bit lower than this level that we saw last August, it is still remains as the highest level. So that's the 100th percent level from an IV ranks perspective. That's why we have such a difference here. The implied volatility percentile, the IV percentile, is telling you that really throughout the last 52 weeks, implied volatility has really been lower basically 95% of the time, 94, 95% of the time. It's almost always lower than it is where it is right now. The rank is kind of almost giving you the impression that we're sort of in the middle of the range of volatility. But for all intents and purposes, really volatility almost never gets higher than this. So the reason I'm going through all this is because you really need to know the difference between these two figures. If you're using the level of implied volatility in order to kind of drive some of your decision making as to where you're going to buy or sell options, you need to know that this rank is really being skewed down in a sense. This IV rank, as you can see back in August when we set that new high, the IV rank was the same as the percentile because we were literally setting that high level of implied volatility. So at that time, that was the highest rank and that was the highest percentile. But now the percentile, in my view, is giving you maybe a little bit more of an accurate view of where implied volatility is sitting, which is really at a very high level. Almost 95th percentile is telling you that almost all the time over in the past history of 52 weeks, the implied volatility has been lower. And the IV rank is kind of not telling you that whole story. So the way that you can use these is up to you. It's not that last August isn't important. I'm not saying that that spike wasn't important. I'm saying that what it does is it's the Bill Gates walking into the room and really kind of pushing up that highest level of volatility, of implied volatility that we have observed over the past year, which is filtering into this IV rank, which is lower than maybe where it should be. So I kind of like the percentile a little more. Now, what you could do is you could take the difference between the two. You could say 94 and 47. Let's split the difference, and that's kind of where we think we are. Let's say like a 70th percentile kind of, high, not at the very top of the range, and certainly not at the very low, low of the range, kind of at the higher end. So the reason this is important for me in particular is because I don't like to sell IV levels that are exceptionally high. I don't really like to sell sort of 85 to 90 and higher in terms of percentile, because that's generally where there's something going on in markets. I think we can see that right now. There's a certain very high level of fear, a lot of realized volatility. Things are moving around at a really good clip. If you look at the ATRs, the average true range, we have some very, very wide ranges. There is a lot of volatility, a lot of fear, a lot of uncertainty out there. And so when we get to these periods, for me, I'm not a huge fan of selling into an existing storm or perhaps an oncoming or increasing storm. And so I like to kind of wait for my opportunities, be a little bit more selective, really start to get a feel for where volatility is topping, both implied and historical. I like historical to start to come down to make me feel like there's maybe the coast is clear a little bit. Because remember, when we're selling options, we're kind of selling the leverage, right? We have a certain downside to doing that that we have to respect. And so we mitigate that risk by staying out of trouble as much as we can, but then also taking advantage of things when they start to line up in the proper direction. I'm going to get into that in another video, but hopefully this gives you a really nice overview of the two different measures, why they can really differ. And the SPY, the S&P right now, is a great example of why that happens. And this can maybe start to inform some of the strategies that you're using in terms of thinking of, well, are we really high? Are we really low? Are we mid-range? Well, these two numbers are giving you a different story. So you need to understand where that story is coming from. So hopefully you enjoyed that, and we'll see you guys in the next video.